The Colorado Department of Regulatory Agencies, the Division of Real Estate, requires all individual mortgage loan originators to purchase a surety bond before they can have their license issued. However, this requirement isn't technically always a requirement. And if this is your first time getting licensed, you've probably never heard of a surety bond before. And that's why in this short video, I'm gonna help you understand. And if you're doing business in Colorado, you probably wanna know the bonding rules. And that's why in this short video, I'm gonna help you understand what a surety bond is, why Colorado requires the bond, how to purchase your bond and save hundreds of dollars, plus other helpful resources so you can get this process done. Real fast before we get started, rather than say the Colorado Department of Regulatory Agencies, the Division of Real Estate, I'm just gonna say the division to make it easy. Finally, I know it doesn't sound like it's a big deal, but it would mean a lot to me if you get value from this video to hit that like button. It's gonna help this video and you'll be doing me a huge favor. All right, let's get into it and make sure that you're watching the right video. Who is required to get this bond? Colorado, the division, requires mortgage loan originators to purchase this bond. Originators are responsible for brokering first and second mortgages, foreclosure consulting and rescue, home equity lending, reverse mortgage activities, high-cost home loans, modification, among a few other responsibilities. Colorado is actually pretty unique among most states. Most states require mortgage companies to purchase the surety bond. However, in Colorado, it's the individual mortgage loan originator who's responsible for purchasing the bond. But like I mentioned in the beginning, a mortgage company can purchase a surety bond to cover their full-time mortgage loan originators, and I'll get to that soon. We'll go over the bonding options, the bond amounts, and the prices to purchase your bond. But first, let's talk about what is a mortgage surety bond. A surety bond, or in this case, a mortgage surety bond, is a legal contract that acts as a guarantee that you will follow both federal and state mortgage origination laws, follow the specific licensing regulations, service your customers with fair and ethical business practices. In short, this surety bond is the primary tool that your state and your customers are going to use to hold you accountable to the promises that you're making to them. It's for your customers' protection. So if it's a form of protection, what does a mortgage surety bond protect against? The division has a licensing process to qualify mortgage loan originators, including steps such as ensuring they have the appropriate experience, they've passed the appropriate exams, they've completed a criminal background check, among other steps. And despite these licensing requirements, every year there'll be a small handful of mortgage originators and mortgage companies that will purposefully and financially harm their customers so that they can make more money. Examples of these fraudulent actions can include things such as approving a borrower for a loan they can't afford to repay, helping a specific borrower get approved for a loan by providing false information, hindering other borrowers from getting approved by falsifying application information, pushing borrowers into loan products that are not appropriate for them to secure higher fees, creating false fees, among many other activities. This surety bond provides your customers with financial protection if they are harmed by these actions or similar actions. If they do fall victim to something like this, they can make a claim against your surety bond for financial compensation, but only up to the bond amount. And this is why the bond amount is so important. So let's talk about what is the bond amount. The bond amount is set by the division. So if you're purchasing your surety bond as an individual mortgage loan originator, your bond amount is $25,000. But remember I said that the mortgage company can actually purchase can purchase a surety bond to cover their full-time employees. If the number of employees is less than 20, the bond amount is $100,000. If the company has 20 or more mortgage loan originators, the bond amount is $200,000. Just remember, keep in mind the bond amount is the amount of total financial compensation available to customers, but the bond amount is going to definitely affect the price you pay. So let's go over how is a mortgage surety bond's price determined. Mortgage surety bonds are credit driven. This means that you're going to have to get a custom price based on a rate that's quoted from a surety. A surety is just the insurance company that just chooses to underwrite mortgage surety bonds, and every surety is going to be different. They're going to do their own independent analysis of the applicant, primarily based on these three factors: personal credit of the owner or owners, business and industry experience, prior bond claims if any of the owners have been licensed in the past. Based on these factors, the surety is going to quote a rate, and this rate multiplied by your specific bond amount is going to be the price that you pay. Because each surety does their own independent analysis, we've seen rates come in at differences of 1% to 2% plus more. And this is why you should work with Surety Bonds Direct or a specialized surety agency to get you pricing. You see, we work with the best A-rated sureties to price shop for you. So we're gonna go look and collect all the different rates to try to find you the lowest one, which is gonna be the lowest price. Let's look at an example so that you can see this with actual numbers. So for a pricing example, let's look at the $25,000 individual loan amount. just pay attention to how 1 percentage point to 2 percentage point or more can make a huge impact on that price that you're going to pay. A 0.5% rate costs $125. A 1% rate would cost $250. A 2% rate would cost $500. And a 3% rate would cost $750. Now imagine a company purchasing a $100,000 surety bond. You can see the pricing differences will be thousands of dollars. So it really is a lot of money that you can save, money that you can put towards, and the money you save is money that you can put towards application fees, education fees, or exam fees, criminal background check fees. It's a lot of money potentially. And while example pricing is great, you can get your exact price today by going to the link I shared in the description and requesting a free quote. There's no cost to have us price shop for you, and once we get you pricing, there's absolutely no obligation to purchase. So this is free information that you can use to help get through the application process a little bit faster. What happens after you purchase your bond? Once you agree to a price, purchasing your bond is as simple as filling out an online checkout form. The minute your payment is processed, well, actually, before I even talk about that, I do want to stress that the payment is one payment for the entire bond term, which for most mortgage bonds is going to be 12 months. The minute your payment is processed, our issuance team will prepare your bond with the correct form, all the necessary signatures and seals, and the power of attorney. As you probably already know, the entire licensing process goes through the NMLS, the National Multi-State Licensing System. We're going to help you get the bond uploaded into the NMLS because it's electronically filed. There are a few steps that you have to do, but we have a whole outline of what to do, and if you ever get stuck, of course, we'll help you do it. Renewing your mortgage surety bond. As I've alluded to previously, in Colorado, the bond term for a mortgage surety bond is 12 months from the date that you purchase it or the effective date. This is another great reason to work with a specialized surety agency like Surety Bonds Direct because you get assigned your own bond specialist who's going to manage your bond for you. So as your expiration date approaches, they're going to call you 30 to 45 days in advance. Essentially because your bond amount might change. Let's say if you are doing more mortgage volume, you might have to get a higher bond amount. Either way, they're going to have the pricing ready to go for you and make sure that your bond gets renewed on time. And that's the bonding process. It's really short. It only takes about 1 to 2 business days to complete from the moment you request your quote to actually getting your bond filed with the NMLS. Most states do have a mortgage surety bond requirement. So if you're getting licensed in any neighboring states, we can help you with that as well. If you have any questions about this process, ask in the comments. That's what I'm here for. I'll make sure I answer your question and get you the information that you need. Now, I know it doesn't seem like a big deal, but if you can hit that like button, if you got value from the video, it does make a big difference to me and it helps YouTube show this video more, which is always great. Thank you for watching. Good luck getting licensed and good luck in your business.